Do you remember the scroll wheel on the original iPod? Or the touchpad on your old laptop? For a long time, that was Synaptics. They were the interface company. But if you still think of Synaptics as just a touch sensor business, you are missing one of the most dramatic transformations in the semiconductor industry. Today, we're diving deep into Synaptics, ticker symbol SYNA. We have analyzed their financial filings from 2021 all the way through their latest quarterly report for the first quarter of fiscal year 2026. This is a story of a massive strategic pivot, a brutal inventory correction, and the emerging signals of a new growth cycle driven by Edge AI. Let's rewind to 2021 and 2022. This was the peak of the semiconductor supercycle. Synaptics was aggressively transforming its portfolio. They moved away from low-margin mobile display drivers and doubled down on the Internet of Things, or IoT. They acquired DSP Group in 2021 to boost their voice and wireless capabilities. The strategy was working beautifully. In fiscal year 2022, their revenue surged to $1.74 billion, up significantly from $1.34 billion the year before. But the real story was their profitability. Their gross margins expanded rapidly, reaching world-class levels of over 50%. Wall Street loved it. However, as we know, the semiconductor industry is deeply cyclical. As we moved into fiscal year 2023 and 2024, the party ended. The post-pandemic hangover hit hard. Customers who had panicked and double-ordered chips suddenly stopped buying. They had warehouses full of inventory they needed to digest. This inventory destocking phase was painful. Looking at the 10K filings for 2024 and 2025, we see the damage. Revenue contracted sharply. By fiscal year 2024, revenue had dropped to roughly $950 million. That is a steep decline from the peaks. The company had to navigate a harsh environment where consumer demand for electronics softened globally. But here is where the Synaptics story gets interesting. It is about resilience. Despite revenue falling by almost half from the peak, Synaptics managed to protect its gross margins better than many competitors. They refused to chase low-quality revenue just to boost the top line. They stuck to their premium core IoT and enterprise products. This discipline is rare. It meant they took the pain upfront to preserve the long-term value of their business. Now, let's fast forward to the present. We have the 10Q report for the first quarter of fiscal year 2026, covering the period ending September 2025. What is the data telling us? The storm appears to be passing. The heavy inventory correction that plagued them for 2 years is largely in the rearview mirror. We are seeing revenue stabilize and start to climb sequentially. The focus has shifted entirely to what they call core IoT. These are high-performance chips for things like wireless connectivity, video interfacing, and audio processing. More importantly, Synaptics is rebranding itself again, this time as an Edge AI computing company. They are not just connecting devices, they are making them smart. Their new processors, like the Astra series, are designed to run AI models directly on the device, whether it is a security camera, a smart home hub, or a headset, without needing to send data to the cloud. This is the next big wave in tech, and Synaptics is positioning itself right at the center of it. The financials in late 2025 show a company that is leaner and ready to run. Their cash flow remains solid, allowing them to pay down debt and continue buying back stock. The balance sheet is healthy. So, what is the verdict for investors? Synaptics has survived the bust. The cyclical lows of 2023 and 2024 are behind us. The company is now a streamlined, high-margin IoT and AI play. If you believe that the number of smart connected devices in our lives will continue to grow, and that AI will move from data centers to the edge devices in our homes and offices, Synaptics is a name you need to watch. The cycle is turning.